Hello and welcome to my channel. So inheritance tax is complicated. There's no doubt it's complicated. There's so many different things that apply, and quite often in an inheritance tax plan one needs to look at capital gains tax, income tax, all a person's assets, pensions, almost every single part of their finances to determine a suitable plan for them. Now, small errors in inheritance tax planning can cost you literally thousands of pounds, sometimes hundreds of thousands of pounds. So today's video is going to go into what I believe are the two biggest reasons people pay inheritance tax. Hello and welcome back. So my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been helping clients eliminate their inheritance tax with our comprehensive service for more than 18 years. So today's video is going to be talking about the mistakes that people make in their inheritance tax. So first of all, it starts with their wills. So what people tend to do is that they go and see a local high street solicitor, and they sometimes will write trusts into their wills. Because of the transference of the nil rate band and the residential nil rate band, a lot of solicitors don't believe it's worth writing trusts from an outside space, because effectively they've got the allowances that can be transferred into people. So if you don't understand this, you should be looking at my video which talks about the problems with basic wills. Okay, so the problems with basic wills explains why a person should use lifetime trusts instead of will trusts. And trust me, there is a big difference. Other things that need to happen is that sometimes people make percentage gifts to charity. Now, if you've got a big estate and you say, I'm going to leave 10% of my assets to charity, well, it's happened in the past where a will is an open document, right? And sometimes the charities challenge the values that have been placed around all the assets, which can be a nightmare for the executors. So again, careful planning, maybe putting some making gifts out of trust would be more sensible than making gifts directly. But it's how this is done, and it's the nitty-gritty of the detail, while still getting the tax relief by giving the gifts. But it's ideally not to put it in your will, unless it's a small gift of 5,000-10,000 or whatever. Okay, now wills that also can be challenged. So this is another mistake. People sometimes have family disputes and they exclude some of their children or one of their children from their wills. The moment you do that, you leave your will open to be challenged. So we would always recommend that even if you're not going to leave a child, a direct descendant, anything in your will, that you leave them something, it's £500 or whatever, and then put an explanation as to why you've made the decision not to leave them anything other than that small amount of money in the will. So the small amount stipulates that you've actually thought about it and it wasn't an omission. That's the point, which then stops the will being challenged. So the next big mistake people make is a misunderstanding of trust rules and how the 7-year rule works, and also how the 14-year rule works. Now, if you're not aware that there is something called the 14-year rule, then you need to understand this. Okay, so this relates to gifts into trust. So if you can watch my video, which is how the 7-year rule really works, that will help you understand that. Okay, so the other thing is that not only do people misunderstand the 7-year rule, they misunderstand taper relief. Now, taper relief only applies to gifts in excess of the nil rate band. So don't think that I've given away £300,000. After 3 years, the tax on it starts to reduce at 10% a year. No, only if you gift more than 300,000. So If you gift 525,000, then effectively the 325,000 is still in your estate for 7 years, but the extra 200,000, then taper relief starts to apply to that after 3 years. So make sure you understand how taper relief works, because again, that's a mistake that people make. Another big mistake is people used inexperienced advisors. So sometimes people have had financial advisors or whatever for years, when they've been, for the last 20 years when they've been dealing with their pensions and whatnot. But most advisors have a very low understanding of inheritance tax, because for most advisors, their clients are younger, and unless you're a specialist in this area, you can miss stuff. So for instance, look out for my video on why you should use 2 life insurance plans rather than 1, and how that can actually save you money. So using 2 insurance plans rather than 1, you find, is a saving, especially if you utilize a firm which charges fees. Another thing is that people utilize discounted gift trusts. Well, they work, but they are very restrictive in the way that they work. So once again, I would recommend you look at one of our videos, One Trust to Suit Everybody. The last thing is not getting a comprehensive plan, really. You've got to look at the whole thing, all of your finances. How does everything fit together? How do you maintain your lifestyle, keep your risks of your investments and whatnot down, and also make sure that you mitigate and eliminate your inheritance tax? All of the planning should be done at the outset and the beginning, and then implement the plan as one goes along. That's the main point. You should have a full plan before you even start, and that's how we would work. So another mistake is the reliance on business relief plans. Especially I come across clients who are fairly wealthy, and a lot of these plans are put in. What they fail to understand, and sometimes even their advisors fail to understand, that although they may have assessed that plan and it works for business relief when they took it out, that doesn't necessarily mean it'll still work for business relief when they die. So you've got, because the rules change once in a while, you've got to make sure that that's being reviewed on an ongoing basis, because if the rules change, it's assessed on your death, not when you buy the plan in the first place. So if the rules change, you may not get business relief on it. So that, therefore, an ongoing review is essential. AIM stocks is another thing that they're very popular, but again, I find they have big potential risks. People can lose a lot of money on AIM stocks because they can be quite volatile. So although it does work, certainly at the moment, but as I say, the rules could change, then be careful because of the potential loss of capital. No point in saving inheritance tax, I need to lose 50% of the value in the investment falling. Last but not least, using equity release. So sometimes again, equity release plans and gifting the money away. Well, equity release, taking the money out and putting it into a trust, works because you've gifted the money away. If you take equity release and then buy a business relief plan, that doesn't work because that's double counting. This is what I'm talking about in terms of making sure that you use someone who's got experience and expertise on this. Because effectively, HMR say that you've just released the money, you've reduced the value of your estate by equity release, you've now bought a business relief plan, which is also not liable for inheritance tax. They're not going to count both, and therein lies the issue. Okay, so if you take an equity release and just put it in a business relief plan, you won't get both lots of relief, you'll only get one. Okay, or none, depending on what you've put it in and how long it lasts. Okay, so that's some of those. Another big mistake people make is gifting a percentage or all of their main residence. Now, this is potentially very fraught with risk, and we always say to clients, really, you should avoid this, unless it's a deathbed gift, which is something different. Okay, so if you are going to make a gift of your main residence because it's so big or part of it, make sure you're paying market rent, because if you don't pay market rent, the revenue will disallow it for inheritance tax purposes, because you said you've given it away, but you haven't given it away, because nobody can live in a property that they don't own without paying rent. So it has to be an arm's length transaction. So you must pay rent, and then the gift of obviously 7 years will apply. But now you're paying rent on money that you've paid tax on. Then the rent that you're paying to, let's say, your children, they're now paying income tax as well on the rent that you're paying them. And then last but not least, eventually when that property is sold, capital gains tax arises from the time of the gift, because obviously for your children, it's not their main residence. So be very, very careful on gifting a main residence. And if you would like to know more about that, please watch our video on tax on your main residence. So now let's get to what I believe are the two biggest problems and why people pay inheritance tax. Number one, they leave it too late. It's not urgent for most people in their 60s, but it is important. And therefore leaving it and then leaving it and then leaving it, and all of a sudden people are in their 80s and it's too late. I always quote the example of a client of mine dying literally with 3 months to go. Now, he died of a car crash. So we had done his planning and expected him to live 7 years, but he died in a car crash and all the inheritance tax was payable. So don't leave it too late. The other thing is not getting experienced, comprehensive advice. People try and do these things themselves and they make a hash of it, or they deal with people who don't have a full understanding of all the legal side, the tax side, the regulated financial advice side. You need to understand the whole picture before you can give people proper advice. So we sit down with our clients and we understand the legal side. I've been working in this area for 18 years and sat in all the meetings with the lawyers. We've sat in the meetings with the regulated financial advisors, understand that. We've sat in the meetings with the specialist tax accountants, so we understand all that. We can bring it all together and then refer you to the specialist firms to make sure that they're carrying out the work as required. So it's a 3-firm problem. So making sure that you get experienced, comprehensive advice and a full plan, and you understand the full plan before you start to proceed, makes complete sense. So those are the two biggest issues: leaving it too late and not getting comprehensive advice. Okay, I hope you enjoyed that video. If you did, please give us a like, subscribe to our channel if you're interested in inheritance tax. But thanks for listening and goodbye for today. Bye for now.